Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by Tim Miller. G'day, Tim. How are you?
Yeah, going well, Aaron. How are you doing?
Not too bad, thank you. Well, this upcoming month, we have our SMSF tax planning webinar, which is arguably one of our bigger webinars of the year as we look to the various opportunities, strategies, tips, and traps when it comes to your self-managed super fund clients in the lead up to 30 June. And I thought, Tim, today, what we might do is just share some insights into what we see as maybe the three key areas around SMSF tax planning. So to you, I guess, to open the batting is to give us some insights into your thoughts around what you would see as some of the big tax planning opportunities and even issues when it comes to SMSF clients in the lead up to the end of the financial year.
Yeah, look, I think that there's clearly plenty of subjects that we can talk about, but number one is always contributions with reference to the strategies that SMSF members can utilise to get the best tax outcome potentially for themselves, but also the best tax outcome, from a future benefit payment point of view as well. So, there's no time like the present to start planning for the future.
Yeah, and to that extent, I think contributions, when we think about planning before 30 June, it's not just what is the opportunity here, but because of indexation, we also need to, in the planning to 30 June, need to think about the planning as we move to higher figures from a concessional and non-concessional cap as well.
Yeah, well, that's right. And, recently we did the video on the contribution reserving and the use of that as a strategy. And that's certainly something that we'll be highlighting again on that day. But yeah, it's a matter of, is now the time from a contribution point of view, or do we look to the future? What's the best outcome going to be for both the member and for the fund?
Yeah, and from my point of view, when we think about that contribution planning piece, it's also the integration of the different contribution strategies that are available. And I guess you highlighted one of them just a second ago with that concept of a contribution reserve or an unallocated holding account, where we are looking at contributions in this year, but then potentially looking at contributions in the following year. Equally, we could be looking backwards as well. So whilst we've historically seen caps get reduced over time, we have seen much greater flexibility in the way in which we can tackle contributions for our SMSF clients.
Yeah, and look, one of the other things that we've certainly introduced into a lot of our contribution conversations this year is the contribution matrix, where we're looking at the various contribution strategies to identify whether they're right for the family that we're dealing with. So, what strategies are right for blended families versus single member funds and things alike. So, no doubt we'll touch on those subject matters as well on the day.
Absolutely. So that's the first one down. What about your next one?
Well, the next one for me really comes down to, and it's tax planning, but it's more strategic planning around the whole lump sums and pension withdrawal benefits. So, we're getting to that time of the year where people will be potentially looking at topping up what they've taken out, or at least ensuring they've met their minimum pension obligations. So it comes back to that whole concept of, if you're going to draw more than the minimum, how do you wish to draw that amount? So are you looking at it from a lump sum or from a pension point of view? And as I said, it's not necessarily tax because of the non-assessable, non-exempt income side of things, but it's certainly tax centered around tax planning, because you're looking at the tax-free and taxable components of your potentially multiple interests and how you potentially want to rebalance those interests.
Yeah, and cash is important there as well.
Yep.
So cash flow as much as it is tax. We've seen this financial year, we've gone back to ordinary minimum percentages. So the cash flow that's required within the fund is going to be crucial, as you said, to make sure we've got our minimum pension payments, but cash flow, in my view, also extends to not only the benefit payments, but it could be around the investments and stuff in the fund as well. If we think about the requirements to meet ongoing limited recourse borrowing arrangements and so forth. So yeah, from a benefit payment things specifically, making sure your documentation is right is crucial. So if you are, or if you have taken more than the minimum and you want to treat it a certain way, that you can absolutely do it. And then again, as we move forward, I keep sort of going, we're talking before 30 June, but I keep talking about next year as well. But it's that decision that you kind of need to do year on year here in respect to making those elections if you're going to potentially treat those above minimum amounts either as a commutation or potentially in lump sum form.
Yeah, and look, and I sort of take your theme there on investments and cash flow, and I also think that this is a critical time of year to be reviewing the fund investments from a point of view of capital gains tax. So is there benefit in looking at realising certain gains now or potentially losses to offset gains? But also as we move particularly into June, where there's no minimum pension obligation, without any movement in the transfer balance cap, is there benefit in potentially commencing a pension on the 1st of June versus the 1st of July with reference to the potential exempt current pension income deduction that might be factored into the equation?
Yeah, absolutely. Well, that knocks down two. What have you got for your last one there as our sort of top three that we see that you should be focusing on in the lead up to 30 June?
Well, I think you're being harsh on my my counting there, Aaron, because I would have thought that the CGT was actually my
your third one.
my third one. But I think probably from a taxation point of view, I think probably one of the key things is almost, whilst it's certainly tax derived, it's the whole gnarly issue. And for me, I think we both agree that this is not a significant day-to-day transactional issue for self-managed super funds, but I think because this is the end of year one, ultimately, of no associated compliance guidance or leniency from the ATO with regards to non-arm's length income and non-arm's length expenditure, I think really now is the time that we need to be ensuring that that funds are satisfying all of their arm's length requirements with transactions. So, when they're looking at the preparation of returns and other things, ensuring that things are done commercially to make sure we get the best tax outcome for the fund.
Yeah, and I think to that extent, the first couple that we spoke about were what we call member housekeeping from the strategy point of view, but the fund housekeeping is crucial here, where there are a number of things that we have to tidy up. So the gnarly is one, but again, as you start to forward plan with things, there are other aspects, whether it's in respect to updates to nominations, whether it's in respect to considerations of policy changes that may be coming in the future. And the gnarly one is a good example of just the evolution that we see year on year. So to me, I think the tax planning is not only at the fund level in terms of things like gnarly, but it's also then going, well, how do we optimize the tax position of the fund? And therefore, going back to your comment before, what assets do we have? What assets are we holding now? Do we have losses? Do we apply those losses? Do we go back and try and understand whether we had cost-based resets in 2017 as well as part of that sort of process of trying to get the best tax outcomes for our clients? Because we might need to do all that to actually enable ourselves to pay the pensions and so forth that we spoke about in our second tip for the year-end tax planning.
Yeah, absolutely. And, and I guess just to round that out, we don't like to look backwards, rather we look forwards. And when we're looking forwards, things such as ECPI, do we have a possible scenario where we might look at segregating next year assets that we couldn't segregate this year? And, and how does that factor into our decision-making process?
Yeah, absolutely. Well, that's probably given everyone who's watching this some insight into some of the broad and I guess comprehensive topics that we're going to be covering in our upcoming SMSF tax planning session. If you'd like to join us, head over to our smartersmsf.com/events page, and you can find out more about this upcoming event in May. We already have some great registration numbers already. And Tim, not only will we be presenting a 1.5-hour webinar, but we do have our comprehensive checklist that all attendees get as well.
Yes, and that's a subtle reminder of what the work I have ahead of me over the next couple of weeks to finalise the checklist. But it's a very comprehensive document, and and the work we put into that, hopefully the attendees get a fair bit out of it.
Yeah, absolutely. Well, thank you once again for being a part of the Feeling Smarter video this week. Have a great rest of the week. Bye for now.
You too. Bye-bye.